Traders, David with Alexander Trade and Investment Group. Market auction theory or auction market theory, ATM. What is auction market theory? Right? Auction market theory, ATM, is basically a philosophy that financial markets move higher and lower due to imbalances between buyer and seller aggression. And that aggression continues on whether buyers are in control and are being aggressive or sellers are in control and being aggressive. That aggression continues until they meet fair value. What is fair value? Fair value is basically the 70% industry standard of the entire day's movement. It is considered a value high or value low. And in between the value high and value low, you'll find POC, point of control, where the most contracts or most stocks were traded that day. Again, 70% is the industry standard. So if you're looking at my chart and I want to focus on this profile here, which is Monday, March the 24th. And the 70% of value is between value high here and value low here. So if I was to mark these roughly there and here, in between 208.74 and 207.62 is considered the 70% of value that day. That is the bell curve of that entire day. Right, roughly 209.25, it was pretty flat. And then it starts to curve out around 208.74, curves out some more, and then all the way down to 207.62 before it flattens out again. That is the curve, that bell curve, 70% of the entire day. With people who follow auction market theory like myself, I trade based off that. That makes the most sense to me when I trade the market. We all hear about the 70% again because that is the industry standard. But what you never hear about, at least what I never hear people talk about, is that you can find value, fair value inside of the 70% of value. How can you do that? Well, still, we're focusing on this profile here, Monday, March the 24th profile. And again, that's the 70% between 208.74 and 207.62. But if you pay a little closer attention to it, look a little deeper, you can kind of see it again, it flattens out here from the 208.15 roughly area, and then there's a curve, and then it flattens out here, and then it curves, and then it eventually flattens out for the rest of the ride down. Hopefully you've seen that. If not, let me point it out here. There. Okay. Now don't pay attention to this one right quick because we're going to talk about why this is up here. But just these two here, right? This top here, again, it flattens out, and then all of a sudden around 208.73, bell curves out, distribution. Flattens again, and then right around 208.19, bell curves out before it flattens out for the rest of the ride down. So inside of that 70% of the entire day, we were able to find fair value in two different locations. Here, 208.70, let's say 75 roughly, down to 208.34. And then in between that, there was a flat area. And then all of a sudden it curves again, 208.17, all the way down to 207.61. Now, why do I have this one here? Well, I'm gonna add another layer to the two value areas we found inside of the industry standard 70%. So if I was to add volume profile, still focusing on this same profile, you can see why. There was a bit of a volume spike here between 208 89 to 208.84. So a small area, but was spiked there. Something happened here. Some bigger player put in an order that was hit and it drove the market one way or the other. In this case, it drove it down. But outside of that, there was a huge amount of volume in that fair value, which was the first fair value or the top fair value of the 70%. And then volume again subsided. And then all of a sudden there was a spike again here at the bottom, which is the second fair value of this entire day. All right. So how did the market play it, or how do you play it? Well, you would play it just like you would play the 70%, right? You fade from the top of value. So if I was to go ahead and hide it, just like you would play if it was regular. Let me move volume profile a little way as well. So how would you play it? You would play it just like the standard 70%, where you would fade from the top of fair value, or you would buy from the bottom of fair value, or as you may see single print here, you would assume that there's buyers sitting there as well. Or if there was a single print hand, just like this one, you would assume to sell from there. So how do you play it? Just again, you would play it like the 70%. If I was to add those back, you would play it just like you would play the 70%. So on this fair value, you would fade from the top or buy from the bottom, fade from the top or buy from the bottom. Now, there's other aspects that you have to pay attention to. News is one. If there's a news event, obviously, or if there's a report like a PPI, CPI, jobless or something like that, obviously there's other caveats, but that's essentially how you would look or plan your trades. If price was to open or right around this top of value, you would be looking to fade it, right? You would look to fade maybe from here or that volume spike that we saw earlier. If I was to add it back here, you'll fade from there. Okay. So let me remove volume. So how did that play the day after, right? So March the 25th. Obviously, you can see it faded, right? It opened at 208.64 and it closed around 207.68. But let's look at it in order flow. So here's order flow, and I have those same areas in order flow. Here was the top of that value on the 24th, the bottom of that second fair value on the 24th. Here's the top of that fair value area, the second one on the bottom. Here's the bottom of that second fair value. And this little arc right here, that was that volume puck, that little spike of volume right at that 208, 208, let's say 208.90 to 208.83. Price opened at looks like 208.69, right at the top of that volume, spiked it. Maybe um you can argue that it took out some stops, right? Because the market knows where your stops are, and then faded all the way down from that value area down. So all of that would have been an opportunity to fade the market. Hopefully you all able to see that. Let's do another example. Okay. So let's focus on Wednesday, March the 26th. So I'm going to hide. You probably already seen it, but I'm going to hide it. So again, this is March the 26th. Again, this is the 70% of the day. That's the value high of that day. And this is the value low. And we're focusing on this profile here. So that is a flat area, which is not really flat because you can see it poked out here. Hopefully you can see that in advance. But this is the 70% of value that the market created. Now, if we go a little deeper than that, we can see value within value, and sometimes you can find value out of value. Like, I don't know if you guys noticed already, but there was a little puck right there. It faded a little, I say puck, a little bell curve there, faded, bell curve here, faded, bell curve here. Okay. So let me add so you can see it. If you can't, boom. So I didn't add those. I'm going to remove these two at the top so it won't confuse. We already went through those. So I didn't add this bell curve, but I'm gonna do it right now. All right, flat, poked out, little curve, and then it flattens out. I'm gonna say here, flattens out, and then it curves again there, and then flattens out. All right. And if I add volume profile to it, you can see it a little clearer. Okay. Here's volume of the same profile. Volume, there's a spike right at the top of this. Well, there's three different value areas here, here, and here. So the top value price volume spiked. So there was definitely some bigger player making some move here. Flattens out, spikes a little bit here, kind of the same as the one at the top. Flattens out, and then again, it's the bigger bell curve for volume spikes here. Okay, so it's three different curves. So how did you play it? Again, you would play it just like you would play the 70%. If I was to hide those, you would look for a selling opportunity here or buying opportunity here. But that's the 70% of the day. So we were able to identify three different fair value areas within this entire day. One slightly out of the 70%, but the other two inside of it. Here, right? This one is slightly outside of the 70%. This one is actually inside of the 70%. And this is the second one inside of the 70%. One, two, three different fair value areas. Again, how do you play it? You fade from the top of the fair value or you buy from the bottom. You don't place any orders in the middle of these because that's no fair value. Market is going to go through it, whether to the upside or downside. Like market buyers or market sellers, aggressive market buyers or aggressive market sellers are going to continue that aggression until they find another fair value area. So how did they play it? So for Wednesday or Thursday the 27th, how did the market play it? Let's go to it. Here's that same day. Yep, that is the 25th. Let's go to see if I can go to the 27th real quick here. Bear with me. Okay. Is that the 27th? Yes. And just scroll all the way down. That's it right there. Open it up. Here's the bottom of the third one. Remember, we had one, two, and three. Market opened in the middle, or sorry, in the top of the third fair value area. So what did the market do to it? Let's open it back up and let's widen it up a little bit. So here is cash open. Market opened at, let's see, 205.33. Kind of at the top of that fair value. You can see at 920, price wouldn't go past it. 925. So you got it opportunity to see that. And actually, let me remove VWAP so it can make it a little cleaner. There we go. Market open 205.33. Not, I mean, price is not going to be perfect, but almost at the top of that fair value. And then you can see price open there, tried to spike it, but dropped. And also made a stack imbalance in that same candle here to here. So sellers were really aggressive to the downside. And you can see price first 5 minutes dropped from 205.33 and eventually buyers came back into it around 203.76. Okay. So auction market theory, again, it's a philosophy that financial markets move higher or lower due to imbalances between aggressive buyers and aggressive sellers. And that aggression continues until it finds fair value. Fair value is basically an agreement or the most trades between buyers and sellers in a location. For those, again, who use ATM in their trading strategy, you were always taught or you probably always heard about the 70% value high, value low of the entire day. But if you go a little deeper, you can find multiple fair values or bell curves inside of the 70%. I wanted to do a quick video just to explain that. I told my Discord that I would. I hope you guys found value. Now, granted, I don't claim to be a teacher, so I really hope that you were able to grasp onto it and that I was able to explain it correctly. And if not, leave a comment. I'll more than welcome to answer any questions that you may have. Again, this is David with Alexander Trading and Investment Group, Auction Market Theory. Y'all have a great one.